All right, what is up, everybody? Why investing early is important, even if you are broke. That's what we're going to be getting into today. All right, here's a financial disclaimer just saying that this is just for educational purposes only. So, most people feel like they're behind on their savings, and this is really no surprise just because, you know, more than half of Americans that are working full time or part time they just feel like they're behind, and that's just the general census right now. Especially with consumer sentiment at the bottom right now, most people are feeling like they're back in 2008, not really, getting anywhere in life. So I thought I'd put up this article to illustrate that real quickly. So now this right here, this chart just kind of shows, or table kind of shows for the most part, the median retirement savings for every age group. If I'm not mistaken, this is from T Rowe. They kind of show every age group as to how much they have for their retirement. So anybody under the age of 35, they have roughly, in the median, roughly $18,000. Anybody under the age of 35. Anybody late 30s, early 40s, roughly 45,000, so on and so forth. And it looks like people, when they retire, at best, they roughly have $200,000. And I mean, realistically speaking, for most people, if they had that in straight cash, that would only last them four years if they spent 50,000 a year. But realistically, for most people, especially if they're married couple, that's not gonna even survive them for that long. So most people right now aren't even reaching their savings goals. So I'm getting into this topic today, just kind of discuss why it's important. So first off, we're going to the slide, the power of compound interest. It's very important just because the younger you start, the better it is. And that's kind of the synopsis of this video, just kind of illustrate as to why it's important to start when you're young. Because the example at the bottom, you can see that if you're starting with $100 a month at the age of 25, by the time at retirement age, you have over $600,000. And whereas if you start 10 years later, you probably might have half that, which just really shows and illustrates why the younger you are, the better it is to get started doing it. And that's probably why most people in the previous slide kind of don't have as much, probably because they started later in life, maybe when they're 40 or 50, and they kind of realized, oh shoot, retirement's coming around the corner, so I probably should get started on savings. And they don't get as far as they hoped. So this next slide kind of illustrates that very point for the most part, kind of what $100 a month does for every age group. So if you start at the age of 25, 40 years at 65, when most people are supposed to retire, you would have over $600,000. If you're start at the age of 35, you would have $225,000, and so on and so forth. 45, 75,000, and age 55 would only be $20,000. So, and adding $100 a month really isn't even that much. Even if you start 25, because for a retirement account, that only would be like $600,000 for you to sustain the rest of your life if you retire at 65. Because if you live till 85, you wouldn't have enough by that time, especially if you take $50,000 out of it every year. So, and this kind of goes into more detail. I really like this graph because this kind of shows, for the most part, the nominal 10% return every year is if you invested how much you would need to make $1,000,000. So if you're at the age of 25, you can see on the far left, you need $158 per month to make it to $1,000,000. But the red bar kind of more so illustrates how, if you had inflation adjusted amounts, which, as you can see in the top left, it shows 6.8% returns if you're including inflation. So it drops the return a little bit to match inflation, so that $1 million in the future would be kind of what $1 million now would be. And so most people really don't think about that, how $1 million now versus 40 years from now won't be the same. So realistically, at the age of 25, to make it to $1 million, inflation adjusted, you probably would need over $403 a month, which for most people, in that age group is almost unattainable. And further you go down the line, the worse it gets, really. If you start investing at the age of 35, if you want to have $1 million in a retirement account, inflation adjusted, you would need to save over $853 a month, which is ridiculous for most people, considering most people can't even save a couple $100. So this chart just really illustrates, just pretty much for the most part, that you really, really need to start at a young age. Because the younger it is, obviously it's cut in half. I mean, every decade you could see, at age 25, inflation adjusted to make $1 million, 403. At age 35, 853. 45, you need almost $2,000. 55, forget it, $5,900. Age 60, $14,000 a month, which obviously, that's a little too late at that point. But this chart is just pretty much to show you, every decade you wait, you got to pay twice as much into this, into the system, or the market, and all this pretty much just kind of displays and shows that, based off the historical return 10%, this is just assuming you put all the money into stocks, nothing else. So this can be a whopping amount, especially if you're in your later years. But if you're really young, this might be attainable for most people. So, and this slide kind of illustrates and shows that historically, over a 20-year period, investors have never have lost any money in the market like the S&P 500, and broad index funds, especially U.S., mostly U.S. Now, maybe some foreign ones, but U.S. ones like the S&P 500, which are the top 500 companies in the United States, over any 20-year period, historically, at least over the past 20 years, no one's ever lost any money. But that doesn't mean that there weren't down in inflation terms, but that's another point for another day. So this chart from TradingView just kind of shows, over the past 20 years, how the S&P 500 has done. And as you can see, that it's gone up over 410%. So obviously, as late, people can see the big wicks down as of in the recent years. The wicks down, but overall, being up over 410% is not too bad. Now, obviously, in the past 10-15 years, the market has been on a really good run. But anybody who really wasn't invested too much in the market during that time kind of got left behind, just because if you had your money in cash, $10,000 20 years ago, it's still $10,000 today. Whereas if you had $10,000 20 years ago and put it in the market, then you had 4 or 5 times as much as you do now. And so that it just kind of can create that gap between people over the years, people who are investing in the market and people who aren't. And most people, you don't want to be behind. You want to save as much as you can while you're young. So this is just pretty much to show why it's important overall. So, and this kind of just ties back into what I was saying earlier. For the most part, starting young is really, really important. The younger you can get started, is best for you. But and this shows what dollar amount per month would equal what number in the end. So, and this is based off of retiring at 65. So if you're at the age of 25, all these are based off the age of 25. So if you start at the age of 25 with $100 a month, at the end you would have over $630,000. If you have $250 a month, you have 1.5 million, and then double that, 3.1 million from 500 a month and 1,000 a month, 6.3 million. Now I know most people, they're probably not going to obviously do $1,000 a month, but that's just to show how it really jumps up in value the more and more you put in. And if you notice, $250 is 1.5, and $500 a month is 3.1, which is double it. So if you put $100 in and you put twice as much in, $200 a month, you're going to be, in the end, making twice as much, as you would if you put $100 in. And you can see that between the $250 a month, the $500 a month, and $1,000. So if you double anything per month, you're making twice as much a month. So that's very important to keep in mind. Someone may think, me putting $200 a month, or putting $100 a month instead of $200 a month, ain't that big of a deal. But really, it is. In the end, it is. It is a big deal, especially consistently over time. And that's one of the biggest things is consistency. If people can be consistent with this over time, they'll do very well with good habits. It's just most people don't have good habits and don't stick with it too much. So that's kind of the biggest downside of most people, is that they don't stick with it, and they take out the money early just because they see it as a big lump sum amount that they have in their accounts, and then they go buy out a boat or something. But yeah, let's see what's next. But yeah, this is a really cool infographic. 70% of people who are in the 20s who start saving reach their goals. So if you're in your 20s, you have a 70% likelihood of reaching your retirement goals if you start in your 20s, than those who wait later in life. So, and it's just because it's easier. The compounding is easier when you're younger. If you start in your 20s or even your 30s, or a little older, you get this compounding effect to where, honestly, it can get so big to where later in life you may not have to invest as much. It's those early years that really, really matter in the beginning, because after like 40 or so, if you got over 500,000 or $1 million portfolio or whatever number it is, adding $100 a month really, at that point you're really doing a whole heck of a lot. It was those early years that really, really mattered for those people. It was the early years that really mattered. So that's something to keep in mind if you're ever taking money in or out of all these investing accounts, especially if you're young. It can affect the future. So, but yeah, so if someone had this chart is to show a few things. First thing being, if you had $1 million, what would it look like if you took 50,000 out every year annually? So obviously, simple math. 20 years out, you have $0. If you start at 65, you end at 85, you have $0. So you could live for 20 years without working, without doing anything, if you withdrew 50,000 a year. Now, the interesting thing though is this is assuming you take it all out in cash, which most people wouldn't do. The better thing to do would be hold it in the market. And by doing so, if you hold it in the market, as you're taking the money out, you'll be gaining more value. So if you take $1 out, or whatever amount it is, the rest of the money that's still in there is still going up. So this chart shows if you had your money still in the market. So if you had $1 million still in the market when you're 65, or whatever number you have at retirement age, $1 million is just a nice round number. If you had $1 million at 65, and you took out 5% a year, which was $50,000 a year, your money, hypothetically, if the market kept the same returns as it did historically over the past 100 years, would go up indefinitely. Because you can see going down the line all the way to 94 years old, the portfolio goes over to $3.5 million. And that's because if you take out 5%, but you're getting 10%, there's a little bit of gain still going on throughout the years. So hypothetically speaking, you never really lose it, you won't, hypothetically, like, if everything, has stayed the same over the past 100 years, you wouldn't, go down to complete zero and burn down like the previous slide. Now, there can be, crazy swings, like in 2008 where the market goes, 50% down, and that can sway the data a little bit. But since 2008, the market has been on an absolute tear. So, and most people say like a 3% withdrawal, is safe, and some people say a 4%. The reason why I did 5% is just because 5% of $1 million is $50,000 a year, and that just makes it easy for most people to kind of, visualize and understand, what's real. Because someone did 3% of $1 million. 3% of $1 million is only $30,000 a year, so it doesn't even. That's not much for most people. Most people can't live off that, and some people can't live off 50,000. Some people need more than that, and therefore they probably need to have a higher anticipated retirement account number, a higher freedom number, to be free and retire. So it really depends on the person how much they need to reach those goals. And so people just need to do what's best for them. So let's see what else is on here. Yeah, so here's just another slide. If you put, same one as earlier, but if you put $250 a month, let's see what else I got. Here's inflation adjusted. So yeah, you could look, if you look at the $250 a month, it goes all the way down to $619. So it's 1.5 million here if you start at age 25. But if you start at age 25 here, if you have inflation adjusted, it's $620,000. So $1.5 million today, seems like a lot to retire on, but in 40 years, 1.6 or $1.5 million will only be $620,000 in the future. So, inflation is something that most people have to consider, and a lot of people really don't think about it too much, and it really can decay and set people back, and erode at their money without them even realizing it. Because there's a lot of people out there that have thousands of dollars in their bank account, but they don't really see that getting eaten away because the number stays the same. But if the number went down over time, people would see it then, obviously. If the $1,000 went to $990 and so on, well then yeah, they would invest it or do other things with it. But I think that's one of the silent killers of money most of the time. And this chart illustrates it. What is that? A third? That's a third of it. So it gets affected greatly, and we could see that before in the earlier slide, how you have to double it every single time practically to meet inflation expectations. And the other thing is that all these investing related stuff, you have to keep in mind, this is assuming like a full stock portfolio. This is assuming only stocks, no bonds, no like I would say mutual funds, but they're very similar to it. This is assuming no money market accounts, no bonds, no other stuff. And obviously with those, you get a lot less percentage in gain. You get like 4 or 5%. And those are some of the good ones, honestly. So, getting 10% is your best opportunity. And obviously, if you're going with those only, you're going to be paying way more than a lot of these numbers show to reach those retirement numbers that most people want to reach. And that's why a lot of people stick with only stocks, just because the returns they can get, and the hopes of reaching retirement faster. And I know for some people this is kind of discerning to see how much these are throughout the years, but it's unfortunate that the numbers are what they are. But because I know most people, it's hard for them to shill away, for example, $400+ a month at age 25. I mean, most people, most people can't do that. I mean, that's like almost 6,000 a year, 5 to 6,000 a year that they're saving. And I know most people, my age aren't doing that. People even 35 aren't doing that, or so on. Most people are just spending money on, new trucks and whatnot. And so, all that to say is that, just be prepared. Just prepare yourself for the future, and just save as much as you can, but also, live your life a little bit, obviously, and take a little bit out to enjoy yourself, a little bit here and there. Maybe 1%, one year, and 1% some other year, just so you can, live your life a little bit, and not feel like you're just holding it all in, and never really living your life. So anywho, thanks for watching the video. Please subscribe, and see you guys.